So what does a Roth conversion look like for a client that has investable assets of about $5 million? Majority of that being in pre-taxed accounts, whereas we're thinking it might be better to pay tax at today's lower rates, assuming that tomorrow's rates should be higher. So let's go ahead and jump in and take a look. So before diagnosing a Roth conversion, we look for two symptoms: their asset weight and a conversion window. So let me go ahead and open up a report and we'll look at the asset weight first. So what we're looking for here is assets as of today to give us this cool looking pie chart. And from the pie chart, we see retirement assets. That's what we want to focus in on. So far 70%, but we want to see the split between their Roths if they're here, and they do have Roths, both clients. So client has a 401k of 2 mil, and the spouse has 401k of 1 mil. So that $3 million combined makes up 75% of the retirement assets, which is 70% of all their assets, investable assets. And that's rather high. So the idea here is typically you have three tax buckets. The first is going to be a brokerage account, which is taxed annually. The second is going to be your deferred tax accounts, such as a 401k and IRA, what we're seeing here. And then lastly, your tax-free accounts, such as Roth IRA, and sometimes could be like cash value life insurance, where you're taking loans from the cash value to promote tax-free. And so we see that they're heavily weighted to that second bucket, which is the pre-tax bucket. So everything that comes out of that account, they'll have to pay ordinary income tax on. So the idea is to move some of that monies out of those accounts, pay the tax today, and hope that the taxes of tomorrow will be higher. Next, we'll look to see if they have a conversion window. And a conversion window is pretty simple. It's just a lower effective tax rate followed by a higher one. And I'll show you, it'll become very obvious once we open the screen. So if I go down to the income tax tab, what we're looking for is something like this, where you see that 10 years preceding their RMDs, they have this lower tax rate environment. Their effective tax rate, the amount of tax they pay per dollar that they earn during this time, is much lower than it is out here into the future, especially as we get further into like their 80s, where it's 20 some odd percent. So what we want to do is take advantage of the conversion throughout this 10-year period. So I'm going to go ahead and jump into a plan making session where I'm going to create a scenario where we are distributing from their IRAs and contributing those distributions into their Roths. And we're going to see some changes here. I'll come right back to this screen. And then lastly, we'll end with totaling their lifetime tax in both scenarios to see which one is lower. So I'm going to save us some time. I've already pre-built these. So the first one I did is a 25% conversion. It was an arbitrary number. And the idea here is that we're just going to take the spouse's 401k. It's 25% of the retirement assets, and we're going to convert that over. So I'm going to open this for you guys so you can see what I did here. So if I click in here to transfer flows, it becomes pretty obvious. We're taking 250k per year over let's see if I can get this to come over, 22, 23, 24, 25, over a 4-year period. Now we could split that up over those 10 years, but just bear with me. So this 250 ends up being the $1 million that spouse has in their 401k. Now do keep in mind that as we're taking and making distributions from the account at 250, the balance there, like in the first year, there'll still be 750 there, assuming growth. And the same will be said for all 4 years. Now that interest will end up leaving an account balance. So even though we pull the $1 million out over 4 years, the 401k won't be drained. They'll still have some of that asset because the interest will be left behind, but we'll still have taken 1 million over via the Roth conversion. So let's go ahead over and to reports and see what that produces for us. All right, so we can see that by clicking here on 25% conversion and hitting update. And let's see what happens to the income tax report first. All right, so we can see that the effective tax rate jumped up those first 4 years, right? Because we were floating right around 10, 11%. Now it's 18 to 17 to those first 4 years. And that's because if we look at the ledger, wrong tab. and we click on tax events, we can see investment income 250. That is likely it. Let's see if we can go back to assets and get a better idea. It should give us the debit from the account. There it is. So we can see the spouse's 401k. We've got $250,000 transferring out of that account and into the Roth, the spouse's Roth. And then if we go back to tax events, we should see that pop up as a taxable event right there. So we are paying tax on that 250. That's why that effective tax rate jumps in those first 4 years. All right, so we know that the conversion is working. We are taking from the IRA, the 401k, excuse me, and we're depositing into the Roth IRA. Now the question is, what does this do for us in terms of tax reduction? And what I'm going to do now is I'm going to jump to the income tax worksheet. And I'm going to take a look at the lifetime tax liability here by setting this to all years. And here's the total tax, right? So if we add all of these up, that'll tell us what our lifetime tax is. And we can do a comparison between the two. So I normally just do this in Excel sheet because the system doesn't, for some reason, the system doesn't total down here, give a lifetime total down here. So what I can do though is I can open up an Excel sheet. So let's do just a new Excel sheet in here. And coming back, let's start with base facts so we can see what the tax is without the savings. So I'm gonna go ahead and drag all the way up. We know what was it? So I think I grabbed 510 at the bottom, and we've got 25 at the top. Sometimes these get out of alignment. So that 25's got to come over here. And we've got that 510. Let me just double check that. 510 at the bottom. So now what we'll do is we'll just take a sum of all the rows, and the total lifetime tax liability is $10,109,108. Now let's compare that to the other scenario where we can go into a 25% conversion and we'll do the same thing. So we can already see it's a little bit lower there, but let's find out how much lower. I'm just going to bring this down here so you guys can actually see the numbers. Hopefully you can see the numbers. And there I think we started with 90. It's going to be higher in that first year because we're converting. And it's going to end with 369. Start with 90, end with 369. Here's 90 here. And if we pull that to the right and we sum it, I know there's probably shortcuts for this. 8,068,000. And then all we have to do is take a look at the difference between the two with an sum. I think you could just do it like equals, what is that? G42 less G85. And I should do it the other way around to get the negative, but this is negative. Here, I'll make it red. Okay, there you go. So, or you could do it green, right? Because it's the amount of tax that you'd be saving. But if they do not convert, they're looking at paying an additional $2 million in tax during their lifetime. So obviously the plan tells us that they would be better off starting that conversion. Now, one thing we could do is we can go back and take the $1 million over 10 years instead of 4 years, hoping that would reduce the amount of tax they pay during conversion. That's a possibility. Instead of that, what I'm going to do though is I'm going to run it at 50% for you guys. So why don't we take 50% of the retirement assets and convert? And I've already built that plan, so I'll just jump straight to it. So here we have a 50%, and all we do is hit update, and then we'll grab the numbers 262 and 117. So obviously the amount of tax we're paying those first 4 years is much higher because we're converting about, I believe it's $500,000 per year. So let's go back here. And if we go to plans and into this one, 50%, We got two transfers. First is for $250 over the same 4-year period, and that's from the spouse's 401k, the $150. And then I'm assuming the second one is $250 over 4 years. Yeah, so we're doing $2 million instead of $1 million. So if I come back and I grab the total on those, let's take a look at what we got. I'll just move this up here for now. I'll just delete it for now. It was 177, 323. Yeah. And then we ended with 262,494. Let's get a sum going. $6 million, let's make sure the rows are right, to G128, 89 to 128. Now I'm second checking, double guessing myself. 45 and G3, yes, to 41. Yeah, these are correct. So 6 mil here. And the difference between that 6 mil and where we started was G42. So equal G42 less the G129. I'm gonna do it right this time. G129 less G, was it 42? Yeah. So they're giving up, they're paying an additional nearly $4 million if they do not convert that 2 million. So in this instance, it makes sense for the client to begin a Roth conversion. Let's take a look at let's go back to the assets worksheet and see how things look 5 years out, the pie chart. So 5 years, I think we are done by 2025. Well, that makes sense that we still have 70% of the retirement assets. It's here that we're interested. So look at how much more even that chart is. We've got so we got a lot more now in the Roth, the two Roths. It's, 66% or something. And then we got about, 32, 33 or something like that, 34% in the 401ks. So all the monies in the Roths at distribution will be tax-free.